CF benchmarks.
So, I mean, is there any sense that maybe some of this is happening a little bit too fast?
It's a great point that you raise. I would change the positioning a bit though, because I think one thing that this current SEC administration is doing a fantastic job at is speaking to the industry as a whole and learning what the pitfalls of any potential change they make could be, right? So they've definitely taken they've done the hard education work, and that's definitely on the background of all these decisions that we're seeing come to light. Now, in terms of it being too fast, I think there could be a world, and we're likely going to be in it in the near term, where investors of all kinds, right? Whether you're a retail investor, you're a financial advisor, you're going to need to come to terms with the education part yourself on these different assets. And so to your point, Ken, we started with a Bitcoin race in January 24. Ethereum came as a fast follow. And that took education work and from issuers like 21Shares and from providers like you guys. And that's going to continue as the list continues to expand, and the value proposition of each one of these assets very significantly, right? It's not you can really bucket them all in a clean and neat way. And so it's going to take some legwork from investors to really get comfortable with the different products.
It's like a good problem to have, I think.
It's a great problem to have. Yeah. And I mean, look, like we often point to our European experience as, how markets kind of come into play and clients begin to understand the different value propositions. In Europe, we're tracking, I want to say 27, 28 different single assets and products at this stage. And there's different buying groups for each one, right? And some, like the Bitcoins of the world, are, I would say, a bit more far along in the institutional or that advisor adoption phase than others that are probably just getting started and are building their own brand.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, brought to you by CF Benchmarks, the world's largest crypto index provider. Hey everybody, thanks for joining us for another episode of CFB Talks Digital Assets. I'm Ken O'Deleger, Head of Content, and as usual, I'm joined by my colleagues, Gabe Selby, who's Head of Research, and Mark Pilipchuk, who's our Research Analyst. Good afternoon, gentlemen.
Good to be here, Ken.
Good afternoon, Ken.
Today, we have an extra special guest, Mr. Federico Brokate. Did I pronounce that correctly, Federico?
Ken, that was beautiful. Thank you for saying it that way.
Okay. And Federico is, of course, VP, Head of US Business for 21Shares. And Federico, we are really pleased and very appreciative that you've taken time out of your busy schedule to join us.
Oh, thank you so much for having me, guys. It's great to see you all and to hop on this conversation together.
Now, just to set the scene, of course, a lot of you will know that 21Shares is probably one of the biggest digital asset-focused investment management firms of its kind, and one of the oldest, of course, and one of the best established, having been founded in 2018 in Europe. And now, of course, its business spans both Europe and the United States. It has grown quite, rapidly since then, to basically manage one of the largest Bitcoin ETFs and, of course, one of the largest ETH ETFs. And it's also known in Europe for having launched the first Solana ETF back in 2021, which is now probably their best performing product as far as I understand in Europe. So obviously we're going to talk about that, but also 21Shares does have some additional routes on chain through its arm that it's called 21.co, if I'm pronouncing it correctly, which obviously deals with the wrapped Bitcoin and wrapped Ether products, and also has established a sort of operating system that can handle the entire life cycle of any tokenized asset. So we're obviously going to get into that as well, because Federico has indicated that he's happy to talk about that. So Federico, I guess the easiest way to get into this is what's happening now, or what happened maybe a few weeks ago. Generic listing standards, one of the most exciting developments in basically recent years. What was your general high-level reaction to the approval of generic listing standards, if I may ask you?
Yeah, no, so it's a great question and something that we're very, very excited about today. In my personal opinion, the approval of generic listing standards in the US is a milestone moment for the ETF industry broadly, and definitely for the ETF or the crypto ETF world here in the US. The best way to summarize it is, for the first time, when it comes to crypto ETFs, we're going to have a framework for what will constitute eligibility for different assets that want to be traded in a spot 33 Act ETP. And so we are looking towards a future in which we're able to offer clients here in the US, additional to our Bitcoin and Ethereum products, a whole additional set of crypto assets in an ETF wrapper in a really safe, easy to use, and convenient way to access the crypto markets.
Federico, it's a real pleasure to have you on. It's very timely that you're joining us, today.
Yeah.
I think, having this lined up just when we had the passage of these listing standards really, really timely. And, one of the things that this regulatory change is going to do is going to dramatically, one, speed up the process to launching ETPs. And two, it's going to, I think, I'm going to just kind of guess, but it's probably going to create this fire hose moment of just new product, flying at the walls. For 21Shares, how are you all going to manage your roadmap? How are you guys going to be kind of selective, or are we going to be just kind of trying a lot of different things out to see how the appetite is? How do you approach such a kind of watershed moment?
No, it's a great question. It's actually one of my favorite things that we spend a lot of time on internally today. Ken was referencing a little bit earlier how we really built our reputation in Europe by being the provider with the most optionality of crypto ETPs in that market. And we're certainly looking to do or replicate that strategy for the US market here in the near term. Now, that said, we are very much a research first based company. And so because we've been in the space since 2018 officially, we've seen our fair share of projects that do very well, like Solana, which grew to be our most successful product. And then our fair share of others that we've had to sunset and for whatever reason didn't make the cut. And so when it comes to our US product pipeline, we are taking that same approach and making sure that what we're bringing to the market is something that we believe in, that has a differentiated value proposition for our clients here, but also will constitute eligibility under the new generic listing standards, and we'll be able to bring something that we're excited about to US investors.
Yeah, and when we think about kind of the range of products this opened up to, there's really a lot to unpack there, because it isn't just single asset funds that we're looking at. We now have the potential for multi-token strategies as well as active strategies. And the multi-token and active piece has really not been a big thing in crypto for a while. So I think it could be beneficial for you to walk through from your perspective how this could be beneficial for investors and what this could really unlock for the space.
Yeah, no. So it's actually something that I'm personally pretty passionate about. I used to work at iShares where index investing was the name of the game.
Yeah.
And so as we think about growing in the US market, we often look at examples of what's worked in Europe. And in Europe, we've seen that these multi-coin or index-based crypto strategies have actually been a great gateway, if you will, for new investors to access crypto markets, whether they're retail investors or whether they're more institutionalized or intermediated. It really brings something to all different types of clients that are looking to participate more holistically in crypto markets without needing to be the ones that are either actively picking the coins within the product or the ones that are necessarily taking care of the rebalancing and the maintenance of the product itself. And so we're really excited. We are looking to bring 3 of those types of strategies as well to the US market, 2 top 10 crypto products, one with Bitcoin, one without Bitcoin, and then another 21Shares actively managed products as well.
And in your reading, I guess, from that range of products within the multi-asset space is based on your perception of what sort of investors are seeking, or at least maybe 2 or 3 different cohorts of investors are seeking. Is that the basis of it?
Absolutely. And if I think about, especially investing culture in the US, how many people do we know that don't own an S&P 500 ETF at this stage, right? Most people own either SPY, IVV, or VOO.
Mark does not own that. He's in the
Oh my
triple
God,
level.
Mark.
Yeah, I live on a Bitcoin standard over here.
We found the guy who doesn't.
We found the guy.
Okay, we're gonna have to have a conversation after this, Mark, offline. But I'm a little bit worried about your financial health here. But otherwise, most people do tend to own some sort of S&P 500 low cost product. And it's become kind of the name of the game in US investing, right? People talk often about like what equities are within the S&P 500, what's going to be added, what's going to be removed, how it's been performing. It's often used as a benchmark for broad US equity performance. And so what we're looking to bring to the US is a similar product that investors can feel, oh, this is comprehensive of the majority of Bitcoin or crypto returns, and this will capture all the upside that I need to be correctly allocated to an emerging and quickly growing space.
One of the things that's kind of interesting with the standards that were released is that you have this criteria that you have to meet in order to be, considered, eligible for this 33 Act commodity-based ETP treatment. But we know that there's some gaps there specifically with a lot of major tokens, they maybe don't have a CFTC regulated futures market. Maybe they're not an ISG or international surveillance sharing market. How do you think these gaps are going to get filled? Do you see this being kind of like a major catalyst to start launching CFTC futures on all these other protocols? Are they going to start lobbying, these like the CME group or the Coinbases of the world? How do you see this kind of playing out?
Yeah, it's a really interesting question because I could see it going a variety of different angles, right? Now that we have the quantitative or the qualitative listing standards, we could see more features being onboarded for other tokens and then automatically making them eligible for ETPs. I could also see a world in which some of this regulation evolves, right? This is the first pass that we've seen from the SEC. But to be completely transparent, in Europe, we have a much more diversified product suite under those current regulatory environments. And so as the market digests, I think a lot of these new approvals that we're going to hopefully see here in Q4 of this year, I could see a world in which we get a little bit more comfortable expanding the pie, if you will, or the number of tokens that are included in eligibility. Now, what that regulation takes shape, is it still going to be these three main parameters that we have in place today? It could be, or it could be the case where we're looking at different types of metrics also to constitute eligibility. But that's all to be seen. I think for now, as an issuer, we have quite a number of listings coming up here this year, hopefully, knock on wood. We're certainly excited to get this first batch out the door and then hopefully see what comes next year.
I'm really excited to talk about Solana, obviously. I want to start at the beginning for this one and then open it out to all of you. There'll be some major questions coming from obviously Gabe and Mark as well. But from the really basic stuff, maybe this question is a little bit out of date because we've seen Ethereum come back massively in so many different ways this year. But before that happened, I would have probably asked you why the specific focus on Solana as a sort of network of its kind. It's in the Ethereum mold, if you like. But what can you tell us? Obviously, we know that you have this product in the EU that has done phenomenally well. We know that there's a history of 21Shares interaction with the blockchain, maybe the foundation. I don't know how that works out in practice, but we know that in effect, 21Shares has served as a facilitator of Solana investment, and certainly Solana sort of promulgating the network effect of Solana just by interacting and as a major player within the space. So tell us about Solana. You guys have got a filing in the US. We don't have to talk about it specifically, but what learnings have you sort of like wrought from this experience in Europe that what are investors going into this fund? What are they seeing in this fund that maybe can actually inform us about the kind of investors and the kind of sort of use case that investors in the US might see in a Solana ETF that eventually gets approved?
In Europe, what we commonly hear from clients is they love the fact that there's a growth plus yield component to our fund there, right? And so for listeners that might not be as closely following this, Solana staking yield is typically in that 7 to 8% on an annualized basis. And so if you're an investor that's purchasing a high growth asset or a fast growth asset like Solana is, and on top of that, you're receiving that 7 to 8% in clips, let's call it, that's going to make for a very, very strong product. And so to your point, Ken, Solana is certainly our biggest fund in Europe at this point. I think that we have 1.5 billion in our Solana ETP out of Zurich. So it's been certainly one of our biggest success cases for that market. And I think the real reason, right, on top of the characteristics of the product itself, is that Solana really has a lot of a fantastic value proposition, whether you're a retail user of the blockchain or you're a more institutional user of the blockchain. People, often will quote the high throughput, the low fees, the diverse ecosystem that we have on Solana that allows you to really participate and do many different things and extract a lot of different uses out of the network. And on top of that, they're frequently upgrading and improving the value proposition for Solana. And there's a couple of upgrades coming up here soon that are going to make it even faster, despite it already being one of the fastest operating blockchains. And so when I think about the Solana investment case, I think it's one that comes to life really quickly for individuals and for investors, because you can see how on the retail side, you can use it for payments, for stable coins, remittances. You can use it for trading and NFT trading and purchasing, and even cell phone services, which are now trading, are accessible on Solana for really a fraction of the cost of most, let's call it, main providers. But then at the same time, you have institutions like BlackRock putting BUIDL on Solana. You have Visa settling USDC payments in Solana. You have Shopify integrating Solana Pay. Like the institutional use cases are there to counteract and really balance out the retail uses. And I think that's where investors commonly hit that light bulb moment, on top of the fantastic value proposition of the product itself.
Absolutely. Yeah.
The yield component or the reward component certainly is something that I think is going to be very attractive with, not just, a cohort of investors that are focused on growth, but also the folks that are focused on income. It's great that you're on, because I think you have a lot of experience, talking to the European side and the Solana ETF that's launched there and the success that you've seen there. What do you think has worked with that product in regards to education? Like, how did you educate the clients in Europe on staking, some of the risks about staking, the mechanics of staking, so they kind of understand, is this something that's kind of like my CD at a bank, or is this something that, works a little bit differently?
Yeah, it's a great question. And I think staking really is such a unique value proposition of crypto, really, at the end of the day, that there isn't that parallel one-to-one example from traditional markets that you can point to. I usually compare it to sec lending most frequently, as kind of like the TradFi equivalent to staking, if you will. But yeah, it's something that we take a lot of time doing, and it's something that we make sure that investors understand, because to your point, Gabe, there's a lot of idiosyncratic risk when it comes to investing in a product that does have staking capabilities. And so, one thing we often do is conversations like these, where we're kind of speaking to the market and kind of explaining what goes on with staking and how we run our product and how the operations are managed. But then we do a lot of one-on-one combat, if you will, with especially the more institutionalized investors that we have in Europe, explaining to them our the ins and outs of our fund operations. And we start with terminology, we start with participant and who the players are. We talk about the yield, of course. We talk about all the different benefits, but more importantly, we highlight the different risks that could be involved, because it's not a concept that's available in other parts of the market, I would say.
Yeah. And from an operational standpoint, I think it would be helpful for you to kind of touch on some of the differences from what you're seeing in Europe versus what you're seeing over in the US. We're starting to see staking just come online in the US and some of these ETH and SOL vehicles. What percent of the fund are you staking over there in Europe, and what might that look like in the US?
Yeah, it's a good question. And I think it's one that we've been grappling with since we began staking in our ETFs for the last, I would say, 4 or 5 years out of the European market. For us, the way it all netted out was we have an algorithm or a formula, if you will, that takes in several factors, including the creation and redemption frequency for our product, the activity levels or the queues for some of these exit ramps from staking operations also. And we put all this information together, and the formula spits out a certain percentage of the fund that we can safely stake without putting any liquidity strain on investors that are potentially looking to move in or out of the product. And so it varies by protocol. Solana has shorter staking exit queues than some of the other networks, and so we're able to stake slightly higher percentages of that fund, at least from a European perspective. But ultimately, when it comes to the US, there's still a lot of open questions about how and when staking will be approved for these products. I think we've gotten comfort from the SEC side on the activity, but there's still open tax questions, which will also play a factor into what percentage of the funds are staked and what that ends up looking like for US investors. What I will say, though, it's an amazing value proposition for the product to be able to bring staking to US investors here. And I think the benefit of having these ETFs listed on all sorts of brokerages, or every brokerage for that matter, and where most people get their investment products, and to be able to stake safely in an institutional grade way is going to be a big unlock for the ecosystem as a whole.
I want to just double click a little bit on that. What you brought up was a good point. Right now, I think a major question with regards to getting staking across the finish line is, how do we categorize the reward component, right?
Yeah.
So what are you seeing? I mean, I assume that, the IRS is involved, or maybe they're not involved. Are we waiting to see kind of like, I don't know, the SEC step up, or is the IRS going to step up? In your opinion, what do you think it's going to take to get this moved forward?
It's a good question. And I think back to the conversation or the comments we made earlier around the SEC and the CFTC working together, we need to see something similar here between the IRS and the SEC for staking in US ETPs. And I think at this stage, we have, nominal approvals or comfort, I would say, across the organizations, but the definition and I guess the pen to paper is what we're still waiting for on the taking tax question. And it's something that we're keenly following to see how quickly we can bring this in our Solana ETPs, which it could potentially launch in the near term.
You talked about how the changes in the validator queue weigh into how much can be staked and everything. With that recent spike in the ETH validator exits, how much stress did that kind of put on the fund, and what did you guys kind of take away from that?
It's a great question. Fortunately, this magic formula that I've been talking about had us at a pretty sustainable level for staking in our Ethereum product in Europe, and so we actually had no issues whatsoever related to that increase in wait time. Let's put it that way. Some of our competitors are not necessarily in the same situation, and they may actually be significantly locked up here over the near term, and so as a participant of the market, what we're hoping for is there's no liquidity crunch in any measure for any participant. And so we're waiting to see, but I think there's always creative ways to find liquidity as well, whether it's loans and what have you. And so we are keenly watching what the rest of the market does. But from the 21Shares side, we're in good shape.
Yeah, I think this is definitely going to be something that's worth watching for anyone that's looking to allocate to the space, because seeing how this plays out among different issuers is going to probably change the way that you do diligence a little bit, because this wasn't something you had to think of until now, right?
That's exactly right.
I actually wanted to touch on a different, take that question from a different side, actually, Federico. But regarding that, and you mentioned that number one, there's the on average through general historic periods higher yield from the Solana blockchain so far in the most recent window relative to Ether, which is probably the biggest comparison, most obvious comparison, salient comparison. And then, of course, now we have this at times really quite punishing unbonding period for Ethereum, which I think has been up to 16 days or maybe even higher in recent weeks and months, relative to, I think, 2 to 4 days for Solana on average. Now, there are, obviously crypto is one of the most multivalent asset classes in the world, and how that, how these variables feed into valuation is a bit of a black box. I'm going to ask you to speculate, obviously. What is your perception as to how those general characteristics side by side, Ethereum, Solana, the bonding period, and also what, until recently, I guess, and it's still to an extent, how much you can stake, how much you can legitimately, sort of maintaining your fiduciary duties actually stake, how does that impact the overall valuation view from your point of view, and maybe from investors' point of view as well, from your perceptions?
Yeah, it's a good question, and I think there's a value prop that's differentiated enough for both blockchains to both of them coexist and to both have healthy amounts of growth, right? I'll pick stablecoins as an example of how I think about this. I want to say 80% of all stablecoins are either traded through Ethereum or through Solana, with the lion's share of that being done on the Ethereum network.
Yeah.
So there's this perception of, let's call it, safety that's associated with the size of the Ethereum blockchain at this point in time. And a lot of institutions prefer that, right? And so I think at this stage, it's more about what's the use case, and that's how they will both kind of distinguish and find their own path. Now, crypto is so early that I think there's enough differentiation, like I was saying, between the two, that they could both reasonably take off and have their own swim lanes in which they're the best at, right? One example we often use to talk about it at 21Shares, it's like comparing different app stores, right? So you're comparing the Apple App Store to the Google Play App Store. And so it's different client bases that you're going after, but they're both excellent at delivering for those clients the things that they need the best or the most. And so for us, it's not about picking between our favorite children. It's about highlighting the benefits or the skills of each one, and hopefully setting them up to both, grow from a capital accumulation perspective.
You mentioned the bank loans or banking products as being a solution for helping ETF issuers, stake more. I do think that that's something that a lot of folks aren't really paying attention to. When you look at the world, post, a Clarity Act or post all this, pro crypto regulation, you're going to see a lot more lending teams at major banks willing to, help bridge finance, I think, for staking. That's what I suspect. If you look at, back in my day when I first started in the industry, it was a T+3 settlement for equities. Well, it was very common to have commercial lines of credit that would help bridge, some of these settlements for mutual funds. And nowadays you still have these, ETFs that invest in less liquid assets like bank loans, and those tend to use a lot of commercial lines as well. So I think, before, when it was kind of, uncertain to touch crypto at all, it makes total sense. Banks, didn't want to dive into that space or spin up a lending team on that. But I think that's going to change. And I think that's probably something that's going to enable a lot more participation in staking for these ETFs going forward.
Yeah.
So
I totally agree with that. And I think the rate that some of these loans charge will hopefully come down over time, which makes it a more feasible solution for the ETF issuers as well to manage that liquidity piece. The one thing we haven't talked about on the liquidity front is the liquid staking opportunity as well. And so, we're certainly looking at this. I know other players across the market are as well, but could we incorporate liquid staking tokens into these products so that we can get that utilization rate up as high as possible and have that sitting next to the native token as well?
Obviously, we had that statement out of the SEC in the summer that LST issuance doesn't necessarily constitute a security. And obviously that potentially opens up a whole pathway for products. What is your view as to that? Is that what we're looking at? I mean, clearly that will be somewhere down the line, but is there momentum in that, or are people still uncertain in terms of on the issuer side? So I guess you guys.
Yeah, look, I think just to pull the curtain back a little bit and show you guys a bit about how the product construction works is there's still open questions around if you can have two separate tokens, even though we in the industry think they're largely fungible. But can you have two separate tokens inside of a 33 Act grantor trust product without having any tax issues? So once again, the tax component comes into play here around how we're going to actually set this up in the real world. But all of that said, when we're talking about how we increase utilization rate, I think they're a fantastic tool to increase that percentage of the fund that's able to be staked. And I don't necessarily see it as a standalone product, but I do see it as a very complementary part of the exposure, the package, if you will, that investors are receiving when they're investing in an Ethereum or a Solana ETF.
That's such a great insight. Such a great insight.
all right, it's time to talk about advisors, the exciting
Yeah.
side of crypto markets. No, it's actually getting more exciting because I think, by the day I think we're seeing just more headlines of either a wirehouse, approving an ETP on crypto, or some other, maybe an institutional investor doing their first slug into Bitcoin. How are you all approaching, these channels? Maybe start with the RIA space at 21Shares to maybe the institutional investors. You could talk about a little bit about these other players, pension funds, endowments, things like that.
Yeah, so I think it's the advisor market or the intermediary market as a whole has been one of the most fascinating evolutions since the launch of the Bitcoin products in January 24. When those products launched, everybody was saying, absolutely not. We don't want anything to do with this yet. We need to see how these products perform. We need to go through our usual due diligence. Sometimes they quoted, 3-year timetables before they were comfortable with the product. Others were more, a little bit more lenient and said 1 year. The reality was, though, I think in 24, Bitcoin, 2x by the end of the summer or something like that. And then all of a sudden, everybody was like, what's going on here? And how do we get access to some of these products? It feels like everybody's saying that, but the reality is that the majority of the market is still on the sidelines when it comes to Bitcoin ETFs. I would say, out of the 30 largest home office platforms in the US, maybe 8 or 9 are currently allowing Bitcoin ETFs to be, solicited by advisors or actively sold, rather. And so we're still a ways away from seeing the majority of US wealth markets kind of actually come into the space and continue to contribute, which if you look at flow numbers, I think we're already at like 25 billion this year for Bitcoin ETFs on top of the 30 billion that we saw last year. And we're still just scratching the surface of the largest part of the ETF buying market in this country. So it's certainly, let's call it very bullish and a fantastic tailwind to have over the coming 18 months to 3 years. But the overall conversation has shifted from if we approve Bitcoin ETFs to when we approve Bitcoin, and how we're going to allow our clients to actually get access to that exposure, because you can only, sit on the sidelines with Bitcoin performing and, hovering at the 110 to 115K mark without wanting to get involved for so long, right?
Yeah, absolutely. I wondered, Mark, whether you wanted to touch on the tokenization aspect, which is such a rich theme to sort of like mine.
I think we could touch on tokenization a
Yeah.
bit, because there's a lot that's going a lot going on within the tokenization space right now. We've seen over the last months, really, like the tokenized equity seems to really have come into focus. We've seen whether you're BlackRock going on CNBC and talking about how that's the future. We've had the SEC and the CFTC had a panel yesterday talking more about tokenization of not just equities, but potentially any asset. And now you've got, you even have some crypto native players like Kraken coming in with X stocks and things. So I'd like to kind of first get how 21Shares is looking at approaching asset tokenization and what areas of the market you're kind of looking at right now.
Yeah, totally. Look, I would argue that ETFs were the first tokenization wrapper, if you will, at least mainstream retail focused tokenization wrapper. And I think a lot of the innovation that we're hopefully seeing in that space is going to get, maybe converge the ETF and the tokenized asset world a bit more closer together over time. But at 21Shares, so just to give you guys some color, we split up our company into two halves. So we're all under one roof, but we have the asset management half and we have the on-chain half. And so our on-chain half is where you're going to see things like Wrap Bitcoin, which trades on Solana and on Ethereum. And then somewhere in the middle of those two worlds is our Onyx platform, right? Which is really the piece of technology or proprietary technology that we developed to be able to manage all of our crypto ETFs, but also interact on chain on behalf of those products. And so from a 21Shares perspective, we're certainly looking at the tokenization world and the trends in that market really closely. It's something that we think is going to be completely revolutionary for capital markets down the road. I certainly think that. I don't know if that's a house view, but ultimately, to us, it's it's still a ways away from really being the way that people primarily receive or get access to their investments. And so for now, we're still firmly focused on delivering those ETFs that are able to help unlock these opportunities for all sorts of investors, while continuing to support the growth of on-chain activity, whether it's through tokenization or anything else.
That reminds me that we ourselves have in recent weeks, in fact, been the index provider for a decentralized token portfolio, and I believe it was one of the first DTFs that was based on a regulated multi-asset index. So I'm just thinking, you mentioned ETFs as, in your view, the first sort of tokenized, product. Would ETFs be the low-hanging fruit in terms of tokenization, maybe going forward, or one of the earliest projects that a little bit down the line, in your view?
Sure. When we could tokenize a Bitcoin ETF that trades on chain and is bought by US investors, and it's kind of this whole like revolving circle. Look, I think a lot of the open questions we have right now around the viability of tokenized assets is really the distribution side. How are you going to get it into individuals' hands, and how are they going to access those markets? And there's a lot of open questions there, but those will all over time get resolved, in my opinion. And it's more about how do you continue supporting the growth of that part of the crypto world, so that it can reach its full potential.
Yeah, perfect, brilliant. And as we come up to the last 5 minutes, I think it's only fair. We should have done this a long time ago. What is top of mind for you right now in your vantage point in the US, overseeing the US business, which is, that's quite a vantage point. Such a world of opportunities stretching out, and it just got broader in the literally the last few weeks.
Well, look, I'm super excited about the growth of the space. I think the Clarity Act and the Genius Act, hopefully once the Clarity Act is passed, are going to mark, a milestone moment, a milestone year for this industry. And hopefully a lot of the growth that we see over the next 5 years is based on a lot of these pieces of legislation that we've seen here in the US. Same thing goes for the generic listing standards, right? I think this is all going to encourage much more participation in our ecosystem, in our markets. It's going to make crypto even more mainstream than it is, but not just from a Bitcoin side, but also from a whatever other asset we think could have real legs and real growth. To me, the killer use case of crypto continues to be stable coins. and I, like you guys, I'm sure you're reading these projections about how much in assets we're going to see in stable coins over the next X number of years. I think Citi said something like there will be $2 to $4 trillion in stable coins by 2030. State Street said another 3 trillion. So the number ends with a T, and it's certainly a really exciting prospect for where we're headed. And then back to the tokenization point, once we normalize blockchain-based dollar transactions, the next logical step is what are the other assets that we can use on the blockchain to move blockchain rails, and that's where the investment case for things like Ethereum, Solana, you name it, are all based on that premise that these networks can really move trillions of dollars of worth of assets in whatever shape or form. So I think the future is super exciting. There's never been a better time to be in crypto, in my opinion, and I've never been more bullish on our space.
Likewise, you speak for a lot of us, I'd say, Federico. So yeah, we are so appreciative for you taking time out of your schedule, Federico. And the next half hour or an hour you've got, to spare in the next 3 or 4 months, please come back again and do the same. If you can tolerate our, over enthusiastic
don't
questioning.
Forget, he's got to help Mark on his consultation to delever his portfolio.
He's got to buy that SPX, right? Yeah.
I'm pretty sure I have SPY calls in my portfolio.
I was going to say
calls are not the same thing, Mark.
It's exposure is exposure. It doesn't matter how you get it, right?
Mark, I'm an IVV guy, so we're going to have to take this offline.
There you go. But Federico Brokate, VP, Head of US Business, 21Shares, thank you very, very much for joining us on CFB Talks Digital Assets.
Guys, it's been a pleasure. Thanks for having me.
Wonderful.
Yeah.
Wonderful.
Thank you.
Thanks a lot. So that was Federico Brokate, the VP, Head of US Business of 21Shares. And I know a lot of you agree that when we tend to get these digital asset focused investment management professionals on, it's usually a really insightful conversation. I'm sure you agree that one we just had fits the bill. If you enjoyed it, we've got reams of similar conversations like that now in our back catalog. Navigate to wherever you get your podcasts and find CFB Talks Digital Assets for 50 episodes now, including this one. CFbenchmarks.com is the place to go for the rest of our content. And we'll see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.